2025 has started off on a shaky note with the new Trump administration taking office, bringing a wave of policy shifts that have introduced both uncertainty and opportunity into the stock market. Concerns over tariffs and trade wars continue to grow, creating volatility across multiple sectors, while inflation remains a lingering issue, keeping investors on edge. Despite these challenges, I see some incredible buying opportunities, and I'm going all in on 4 stocks before the end of the year. One of the stocks on my list is brand new, already skyrocketing, and has the potential to create millionaires in 2025. With market swings becoming more unpredictable, identifying stocks with strong fundamentals and long-term growth potential is more important than ever. That's why I'll be ranking these stocks from least to most risky, because while higher risk often comes with higher reward, it's crucial to know what you're getting into before making any investment decisions. The 4 stocks I'll be highlighting are down an average 29% since the sell-off began, with 3 of them well into the bear market of 20% or more. But while everyone else is trying to time the market's bottom, worrying about how much worse it can get, smart investors are looking at that 20 and 30% discount in growth stocks. The first stock on my list is actually my favorite among individual stocks. It has been a popular pick among investors even before 2025, but this year has made it an even stronger buy. Unlike many stocks that have struggled under recent economic pressures, this one has remained steady and is even showing massive growth. It stands out as a leader in the cybersecurity industry, a sector that continues to see increasing demand as businesses and governments prioritize digital protection against cyber threats. With AI-driven cyber attacks on the rise and data breaches becoming more frequent, companies are investing heavily in cutting-edge security solutions. This stock is positioned at the forefront of that movement, making it one of the best opportunities in the market right now. Over the next few minutes, I'll break down each of these 4 stocks, explain why I'm buying them, and how they fit into my overall investment strategy. Before we dive right in, don't forget to hit the subscribe button and turn on the notification bell so that you will not miss any investment opportunity of a lifetime. The first stock on my list is CrowdStrike Holdings, ticker symbol CRWD. CrowdStrike is up for the year but has dropped 22% from its February high. Despite the pullback, the cybersecurity leader remains a dominant force in enterprise security. After last year's massive outage, I started buying CrowdStrike because its Falcon platform remains the best AI-driven security solution available. Unlike legacy security systems, Falcon's AI-native approach continuously adapts to new threats, making it a critical tool for businesses fighting cyber attacks. The numbers back this up. Annual recurring revenue, ARR, is growing at 27%. Its subscription-based model ensures long-term customer retention, and cybersecurity demand remains independent of AI chip cycles. While some AI stocks face concerns over deep-seated competition in AI hardware, cybersecurity is a necessity that corporations can't afford to cut back on. As AI-driven attacks become more advanced, enterprises need real-time AI-powered security to prevent threats before they happen. CrowdStrike's detection speeds are fast enough to neutralize AI-powered cyber threats, positioning it as a leader in next-gen security. With revenue projected to grow at a 21% annual pace this year and next, CrowdStrike's decline has been relatively mild, showing strong institutional investor confidence. Here's why I believe this sell-off could be an opportunity. Its sticky revenue model ensures consistent cash flow, AI-driven security demand is growing, and CrowdStrike is a recognized leader in enterprise security. The recent pullback could be a buying opportunity for long-term investors who believe in AI-powered security. With cyber threats increasing and businesses prioritizing security investments, CrowdStrike is positioned for sustained growth. Would you buy the dip, or are you waiting for a better entry point? Let me know your thoughts in the comments. The next stock on my list is Bank of America, ticker symbol BAC. Currently, Bank of America has a market cap of $311 billion, and its 52-week high was around $48 per share. With the stock now down 15% from those highs, it presents an interesting opportunity, especially as we enter a second Trump presidency. Historically, financials tend to benefit from deregulation, and banks have been one of the most heavily regulated industries since the Great Financial Crisis. A more relaxed regulatory environment could provide a tailwind for big banks like BAC in the coming years. Another factor working in Bank of America's favor is the potential rise in mergers and acquisitions (M&A) activity. If deal-making picks up in the second half of the year, large financial institutions stand to benefit, Additionally, interest rates remain elevated, and with expectations that they'll stay higher for longer, banks can continue to generate strong net interest margins (NIM), the difference between the income they earn from loans and the interest they pay on savings accounts. This is a key driver of profitability for banks. Looking at valuation, BAC trades at a price-to-earnings (PE) ratio of 10.7, but I prefer to assess banks using the price-to-book (PB) ratio, which currently sits at 1.05. Historically, anything close to or below 1 is considered an attractive entry point for bank stocks. On top of that, Bank of America offers a solid 2.6% dividend yield, with a 5-year dividend growth rate of 8%. The company has increased its dividend for 11 consecutive years, showing strong financial stability and commitment to returning capital to shareholders. According to analysts on TipRanks, BAC has an average 12-month price target of nearly $53, which suggests a potential upside of around 30% from current levels. With favorable industry tailwinds, a strong balance sheet, and a solid dividend, Bank of America remains a compelling investment opportunity. The next stock I'm watching closely is GitLab Inc., ticker symbol GTLB, the open-source competitor to GitHub. With Alphabet, Google's parent company, still holding a 3.7% stake worth over $300 million, GitLab is clearly a stock worth watching. But with tech stocks facing increased volatility, is GitLab a buy right now? Let's break it all down. GitLab is an open-source software development platform designed for security, DevOps, and IT operations. Unlike GitHub, which is owned by Microsoft, GitLab provides enterprise-grade solutions that help businesses manage their code development with AI-powered tools. GitLab is free for individuals, but offers paid plans for businesses and enterprises, making it a strong, revenue-generating business. And with AI transforming how software is built, GitLab is one of the leading platforms helping coders develop and deploy faster with fewer errors. That's why GitLab now has over 9,300 enterprise users, including 1,000 customers generating over $100,000 in annual revenue. Alphabet has been an investor in GitLab since before its IPO, and even after selling more than a third of its stake recently, it still holds a significant position. Some analysts see this as Alphabet just locking in some profits rather than losing faith in GitLab's long-term growth. GitLab's revenue is projected to grow at over 20% annually, reaching nearly $1 billion next year. More importantly, earnings are set to skyrocket by 83% annually, hitting an estimated 67 cents per share by fiscal 2026. But with the recent sell-off in tech, GitLab's stock has dropped, making its valuation more attractive. Right now, GitLab trades at 11 times price-to-sales (PS) ratio, still not cheap, but much better than its peak levels last year. Given its strong revenue growth, enterprise adoption, and AI integration, GitLab is definitely an interesting long-term play. However, with ongoing market uncertainty and continued selling pressure on tech stocks, we could see further declines through the summer. So here's my take. If you're a long-term investor, dollar-cost averaging into GitLab at lower prices could be a smart strategy. If you're a short-term trader, watch for potential pullbacks before entering a position. Alphabet has made no major changes to some of its largest holdings, including its 32 million shares of Planet Labs ticker symbol PL, giving it an 11% ownership stake. This investment isn't just about financial returns, it's a strategic move that positions Google at the center of the rapidly expanding Earth imaging and satellite data industry. Planet Labs operates over 200 imaging satellites, more than any other company, and serves a massive addressable market including defense, intelligence, agriculture, and government contracts. More importantly, it plays a critical role in Google Maps, making it an essential part of Alphabet's ecosystem. Financially, Planet Labs is growing at around 15% year over year, expected to hit $292 million in revenue next year, with over 1,000 customers, 90% of whom are locked into long-term contracts. While this growth rate isn't as aggressive as some high-growth tech stocks, Alphabet's long-term vision suggests that this investment is about more than just short-term returns. With shares trading at a reasonable 5x sales multiple, a strong balance sheet, and a unique market position, Planet Labs presents a compelling opportunity. And with Alphabet already owning a significant stake, there's always the potential for an eventual takeover offer which could send shares skyrocketing. If you're looking for undervalued stocks with long-term potential, this is definitely one to watch.